Welcome back. As we prepare for the Bank of Canada's interest rate hike announcement tomorrow, and a hike is widely expected, high inflation continues to fuel expectations of an aggressive rate hike in the Fed as well. That could be as high as 75 basis points. Our next guest says that the worst of the economic turmoil could soon be behind us. We're joined now by Kambiz Kazemi. He's CIO of Validus Risk Management. Kambiz, thank you very much for joining us. In some notes that I've been reading that you have, I believe, posted to your firm's website, you say that some of the transitory drivers of inflation may have peaked and may be on the wane, and that therefore headline inflation may be on the wane as well. Give us your thoughts on where you think we are in the inflation cycle and the campaign by central banks to bring it down.
Yes, hi, for sure. So as you recall, last year, our view was from start of 2021 that inflation was building up, in particular because of the supply chain issues and commodity prices increasing. And we didn't think that that's going to be fading. Central banks were admittedly late at the party in raising the rates. And they have been doing that aggressively, as you were mentioning before, one of your guests, probably creating a shock. And what happens is that, a lot of the transitory part, in our opinion, is starting to assuage itself. When you look at commodity prices, obviously June was an astonishing month. They adjusted across the board almost 30%. There is evidence that supply chain clogs are slowly, improving, and these elements together, they're taking away some of the transitory pressure. Obviously, the other part of the inflation we think is long term, which has to do with greenification of the economy and so on, will stay there. But I heard you mentioning, the signs of whether we have broken the back of the inflation. The problem we have now is that those signs might come out a little bit too late. The same way the rate hikes were too late, we might notice that we have broken the back of the inflation too late. And what we're saying is that we have to be quite careful. We could see within the next few months a scenario where we realize that that's already happening. And at that point, the market is going to be adjusting expectations. So that's a potential scenario that, investors should be ready for.
We have a graph prepared there where we can show viewers what the market appears to be anticipating in terms of rates into the future. The implied rates, the white line shows the more recent expectation of implied rates, showing the Fed funds rate after it increases declining to about 3.0% late in 2023. That's a sharply revised expectation from the blue line, which is what those expectations were in the middle of June.
Yes, it's astonishing how the world has changed in less than 4 weeks. We were pricing essentially rates being by 4% by the end of the year and then stagnating thereon. And obviously, it seems that the markets are, the consensus around the recession talk is gaining momentum. Now we have shaved off about 50 beeps by the end of the cycle, being at 3.5 by the end of the year. And then we're seeing rate cuts being priced in Q1, Q2 of 2023. Actually, you can see how makes for a bit of an odd scenario of, raising rates and consequently cutting rates. I think the last time we had this kind of curve lineup was in 2007. And then the question would be, does this kind of scenario can materialize actually, or there is part of the curve that has to move? Essentially, if we see signs of inflation fading in the next few months, say by the end of the summer, then potentially that, expectation on the front are going to come down. And if the reverse is true, then we might see the back end, go up a little bit again. So it's relatively untenable as a structure of a curve.
Okay, unfortunately, we're almost out of time. What does all of this mean to your view of equity markets and how investors should be positioned?
Yeah, so I think what's going to be important is if we do see actually these signs of fading inflation, that can be pretty constructive for equity markets. We could see some stabilization over there. On the same note, US dollar could start, pausing and potentially reverting a little bit because they have been front runner in raising rates. And finally, this long-term raise on the curve could also stabilize if we see the scenario that we're describing.